Hey everybody, Frank Ioza with FMI Financial. Today is part 2 of a 3-part series in which we are talking about the financial planning risks that we all face regardless of income and wealth. Now, if you missed last week's episode on inflation, be sure to check it out. But today we're talking about the very popular topic, taxes. So taxes are a big part of our mantra of maximizing your keep. And at the end of the day, taxes are definitely something that we're all aware of, but we may not have a conscious strategy for managing our exposure, not just year to year, but for the many years ahead. And while saving is definitely important, there are a lot of different accounts out there, but there are essentially 3 different tax profiles that we can use to manage our tax exposure for the many years ahead. So first we have taxable accounts, and these are going to be accounts titled in individual, joint, or trust names. And these are called taxable accounts because the sale of any investment is what's going to trigger the taxable event, be it a gain or a loss. Now, this is actually a good thing because it allows us the ability to harvest our losses throughout the year, and we can have those capital gains at preferred long-term rates. Next, we have pre-tax contributions. Now, most people are familiar with pre-tax contributions because they reduce your taxable income now, with the trade-off that as we take these dollars out in retirement, we pay ordinary income rates. On the flip side, we can make Roth contributions, where we elect to pay taxes today so that those dollars can grow tax-free. Most people focus exclusively on pre-tax contributions so that they can reduce their taxable income. But what this does is this creates a big question mark for the many years ahead. Many people are familiar with diversifying their investment strategy, but are not familiar with diversifying their tax exposure. As a result of that, we commonly see people with the vast majority, if not all, of their retirement savings in pre-tax dollars. So if you go into your financial plan assuming that tax rates are going to be 20% during your retirement life, and then tax rates go up to 25 or 30%, this is going to raise some significant questions on how long those dollars can actually last you. And because we don't know what tax rates are going to be 5 years from now, let alone 25 years from now, we recommend having all 3 components as a part of your strategy. Roth dollars that are going to be tax-free regardless of where tax rates are, taxable accounts where we can benefit from tax loss harvesting as well as long-term capital gains treatment, and pre-tax dollars to use when tax rates are low. Now, while it is important to have these 3 different tax profiles in place so that you have a number of different ways to manage your tax exposure, the biggest piece that you really want to build out is that Roth piece, because that is a tax-free allocation. And so the sooner you can start carving out that allocation and those dollars growing for you tax-free, the better off and the more security you're going to have in your retirement plan. So while many of us want to limit our taxes today, you really need to have a tax strategy that allows you to manage your tax exposure today without compromising your future. Thanks as always for taking the time to tune in. We'll see you right back here next time. Take care.